Hi, this is Matt Amberson, the principal of ORATS, and we're going to go over two of the new additions to the dashboard. The first addition was adding the ORATS tick volatility and the close-to-close volatility in the same graph. And you could click on ORATS tick vol, and you could see the 20-day, 100-day, and 250-day volatilities there. And if you look at the chart here, you can see going back what the volatilities were at different times. And when we click close to close, I'll ask you to observe that 31.7 is the HV20, the historical volatility of 20 days for the ORATS tick, and when we click close to close, it's 30.23. So that's somewhat significant difference between close to close and ORATS tick vol. Again, 31.7 for ORATS, 30.23 for close to close. The other addition, or the other change that we added to the ORATS dashboard, is the ability to calculate a fair volatility based on an earnings percentage. Now, that fair volatility we estimate as, for this particular stock, 90 days out by interpolating. So 90 days out is somewhere between June and September, and we weight it closer to June as it's 60 days and September is 155 days until that expiration. So somewhere between 32.5 and 33.5 is 32.99 90 days out, and we'll say that that is the fair volatility. Now what we'll want to do is add a certain percentage that we think the stock will move on the day of earnings, and then that will increase the 32.99 some amount. So we will get that percentage, which we have 4 in there, from the earnings table at the bottom. So what we do in the earnings table is we say, okay, the last earnings was 128.10. The time of day was after the close. The stock price was 30.8. We were going to look at the month 1 straddle. The spread price was 245, or 8% of the stock price. The stock went down 4% the day before and 4% the day after. And so since the time of day was after the close, we'll look at the move, the 4%, which is after, and then it went down 5% then in the 10/29/2009 earnings, the 7/23, 1% only. So what we do then is you say, well, the average spread percentage, 8, 9, 10, 14, 13, 10, 9, the average of that is 10%. The absolute moves that the stock had actually made before, on the day of earnings and the day after earnings, was 3%. So 4, 4, 3, 0, 6, 3, 0 average is 3%, and the day after earnings is 4, 5, 1, 1, 6, 9, 4, or an average of 4%. So what we'll do is we'll say, okay, if the fair volatility without earnings is 32.99, we'll assume a 4% move, and then depending on how many days there are till the earnings, we will adjust the earnings upward for that 4% move when the other normal daily moves are 32.99. So that percentage increases the 32.99 up to 34.64. And now we're also able to input a fair volatility. So let's say you think the fair volatility might be, I don't know, 30, let's say. So then with a 30 move on all the days except for the earnings move day, when it moved 4%, that would be a fair volatility of 31.93. the 4% added 1.93 to the 30% normal moves. We could also change that to maybe even 3%, and you could see how that then affects the volatility lower. Or we may want to move this up to 36%, and then what it does is it's coloring this green now as it's comparing the 36.5 to the 32.71, which is the volatility in May right now. So those are the two additions, the ORATS tick volatility versus the close to close, and the ability to put in a fair volatility, add an earnings move percentage, and get a fair earnings volatility. So if you have any questions, my name is Matt Amberson at matt@orats.com, and thank you for your interest in ORATS.